Well, good morning, Frank. Thank you very much
Morning.
for taking some time to chat to us. How are you doing today?
I'm great, thank you. And yourself?
Cool. Yeah, very good. Thank you. Very good. We read the article that you and your team had put out in the Worldwide Financier, and we're really enamored with it, and are very, very grateful to have an opportunity to talk to you about it. I guess your firm must be at the vanguard really of this area, having done tens of billions of dollars of these. So really looking forward to chatting through your experience and your reflections on intangible financing.
Well, it's a pleasure to be here, and obviously welcome the opportunity and spreading the gospel about a transaction structure which I've become a disciple of, and it's become a big part of my practice as well. So looking forward to the conversation.
Cool, brilliant. So yeah, as a good place to kick off, perhaps you could talk a little bit about the firm and your work and what you do in intangibles financing.
Yeah, so obviously Davis Polk is a full service law firm based in New York, and we have a preeminent finance practice. And so historically, as an intellectual property and technology lawyer, my group has handled all of the needs of that group. But what's become increasingly obvious is that the financings have become much more bespoke and less cookie cutter, and that really came to the fore during the pandemic, where so many businesses were facing liquidity crunches and looking for novel sources of financings, and that's where we really got heavily involved in these IP drop-down financings that I talk about in the article, and so it's a fascinating area. It really deploys some pretty cutting-edge deal technology, and I think the reason it hasn't necessarily been explored to the extent that it is now is because the deal technology really cuts across a number of different practice areas. It sort of falls between restructuring, financing, intellectual property, and even capital markets, depending on the structure. And then you have the overlay of a lot of tax planning that goes into it. And so we've been able to create some structures that have really, in the case of the airlines, really saved the industry, because during the pandemic, that source of liquidity was absolutely mission critical for them.
Yeah, cool. And it'll be interesting to zoom in on those a little bit. So can you talk about the structure, at the highest level possible, considering it gets pretty complicated?
Yeah, sure. And so there are basically two structures. One, I think, has found a lot of acceptance in the marketplace, and another's the one that I've been really working with and been speaking to a number of investment bankers who are quite enamored by it. What you're trying to do essentially with the structure at a high level is drop the IP or technology or general intangibles down into a vehicle, and the intangibles should be mission critical, so that the borrower really can't survive without them. And then you put them in some sort of vehicle where you have bankruptcy remoteness. So that if the borrower or the issuer, if it's a bond that's ultimately the structure of the transaction, it becomes distressed, all of the incentives are there on assumption rather than rejection. Because typically in a bankruptcy, at least in the US, there are tremendous incentives for rejection, and the entity freeing itself from onerous obligations. And so the structure requires the drop down of mission critical intangibles, which are bankruptcy remote. And that bankruptcy remoteness, at least in the typical structure, is created through a bankruptcy remote special purpose vehicle. And you create bankruptcy remoteness typically through a golden share, which would need to vote in order for the entity to be put in bankruptcy. And because that golden share is held by someone who doesn't want the entity to go into bankruptcy, it's considered to be bankruptcy remote. And then there are other bells and whistles that you include in that structure. You pledge the shares so that you can foreclose and take control of the SPV and the like. And so that structure is all about keeping the entity out of bankruptcy. The alternative structure, which we can talk about, is allowing the entity to go into bankruptcy, but essentially creating bankruptcy remoteness in the sense that if it goes in, there's a sufficient pressure point and pain for the borrower that it will assume the contract. And so you achieve bankruptcy remoteness in the sense that it will support assumption rather than rejection. And the structure we achieve that through is to exclusively license intellectual property, typically to the collateral agent, rather than dropping it down to the SPV. And the reason that works is because licenses are afforded special protection under the bankruptcy code in the US and also in the UK. And so there's a special provision in the bankruptcy code called 365N, which covers most forms of intellectual property. And then there is also a Supreme Court ruling called Mission Products, which further reinforced the fact that a rejection in bankruptcy doesn't rescind the license. It's just a breach by the licensor, but the licensee continues to enjoy its rights. And so that's essentially the structure in a nutshell. And I appreciate it was not such a high-level response because it is quite nuanced and complicated, but hopefully that at least directionally gives some insight into how you would achieve the desired outcome.
I'm sure that's as high level as you could have gone, but in really simplistic terms, you take the intangible assets, you transfer their ownership to an SPV, and that SPV is what's financed against. The lender has some kind of security over that SPV, whether through a master license or whether through pledging and so on, and therefore the borrower has an incentive to service the financing because in order to normally take ownership back of the SPV, how does the structure unwind? Yeah,
so the way you create the mutually assured destruction tension is the IPs are dropped down. The IP and the intangibles are dropped down, whether through an assignment to an SPV or an exclusive license to the collateral agent, but then they're licensed back. And they're licensed back to the borrower or the issuer so that there's business as usual, that they do not lose anything other than they've created essentially now an encumbrance. Yeah. But if they default and they seek to reject, that license back to the company will be terminated. And so then they lose their freedom to operate. And so they know that rejection now is not a free hit. There's a real consequence to it because now it will lose mission critical assets. And so just to give some illustration to that in case any of the viewers are sort of, well, how does that work? So in the case of the airlines, we dropped the loyalty assets. And the loyalty assets are essentially the frequent flyer database, which is a trade secret. It's know-how. It's a copyright as well because it's protected under the Copyright Act in the United States, and so it is protectable IP. And now those intellectual property rights are held either by the SPV or the collateral agent if we adopted the alternative structure through an exclusive license. But in the airlines, it's typically an SPV. And then those assets are licensed back to the airline. And if the airline ever sought to reject any of the executory obligations that exist, including the non-compete by setting up a rival frequent flyer program, they will lose the right to have access to those frequent flyer database assets. And there are other assets as well. Obviously, the credit card agreements and contracts, which are so lucrative for airlines when you purchase on your credit card and you accumulate miles. A lot of those assets also get contributed, either the contract itself or the proceeds from the contract.
Okay. And I guess this is at the more complicated end of the spectrum for intangible financing, but there would be but IP-backed loans, royalty securitizations, those types of things. Would those always require something like this with a drop down or licensing, or are there simpler ways to accomplish those types of financings?
So securitizations themselves don't necessarily need. You could just securitize the proceeds and take a security interest in the underlying IP that creates those proceeds. As in the case with, say, Bowie bonds and that you see in the music industry, and obviously in the pharma industry, these type of securitizations are very popular. This structure is a little different, and I think the reason why it's gained such favor is because there are additional protections and additional fortifications that really mitigate the insolvency risk of the borrower or the issuer. So the marketplace really likes it. And essentially what you're doing, Dylan, is you're creating a dam wall that's meant to weather any storm, or as much as possible weather any storm, so that if there is an insolvency event, all the dominoes really fall in a way so that the party holding the security has as much leverage in the negotiations as possible, which is typically the way things shake out in an insolvency.
Yeah, have any of these been tested in court yet? Probably not.
The one that I worked on, I wouldn't say it was tested per se, but Revlon, I worked on I represented an ad hoc group of lenders in Revlon, again during the pandemic, and we adopted a very, very similar structure to the one I'm discussing, and in that case, when Revlon filed, our investors actually were able to convert their debt into an equity position where now they control the company, and so the structure certainly held up there. The structure was also tested to not identical, but at least the deal technology was tested during the financial crisis, because where this exclusive license concept came into being, at least from my perspective, is I represented Citibank as part of their participation agreement with American Airlines. And a participation agreement is the agreement by which credit card companies airlines enable credit card companies to purchase miles. And they're obviously hugely lucrative for the airline, but they're also hugely lucrative for the banks, given how popular they are with consumers. And Citi made a pre-purchase of miles, a very significant one, and then American Airlines filed, and because a participation agreement is executory, it could be rejected, but we took an exclusive license to the frequent flyer database assets, and so they couldn't solicit a rival program and then had to assume the whole program. And so the deal technology has been tested in various forms.
Yeah, well, even better, it didn't have to get to court because it was so clear. Cool. You said that you found a lot of favor in the marketplace. Which types of players are? So obviously I've seen your transactions and very big airlines and conglomerates, but how widely is this being considered?
Yeah, it's really agnostic as to intellectual property and technology. It can be any form intangible. I think the real key is if a company has mission critical intangibles, which invariably they do, given that the vast majority of value for the Fortune 500, for instance, is denominated in intangibles. And so any company could be a candidate for this, whether it be a technology company. So we adopted a structure similar to this for Shutterfly. We also represented Sabre, the travel technology company, who were able to pay down a facility utilizing this type of technology. So it can be a technology company, it can be an airline, it can be a brand intensive company like Revlon, and the airlines. I've done this structure for Delta, Spirit, and Azul. And interestingly, the Azul is a fascinating case in point because it was a Brazilian airline that adopted this structure, and I think there's tremendous potential for this structure to be deployed outside of the US. Because most of the US carriers have adopted a structure similar to the one that I'm describing. And that's on the borrower side or issuer side. And then in terms of the appetite of investors really like this structure. So whether it be investment firms like PE or hedge funds, they tend to, when we represent the investor on the direct lending side, that they tend to be the players that get involved in this.
And what is your view as to why investors particularly like it? Better yields than they find elsewhere, or?
Yeah, well, typically borrowers like it because, especially in the case of bonds, the rating agencies understand the structure, and they'll typically give the borrower a lift, and so they'll procure it on more favourable terms. And then on the direct lending side, yes, I also think from a risk mitigation perspective, they're very sophisticated investment firms. They really kick the tires. They understand all of the vulnerabilities. The deal technology that we adopted in Revlon is very, very sophisticated. We required all of the formulas to be put in escrow. It's never a one size fits all. You really have to understand the sort of the mousetrap that you're trying to build and make sure that it's really engineered to meet your needs. But investors like it because it has additional fortifications beyond just having a security interest and having to foreclose and potentially being in a suboptimal outcome where you're foreclosing, but you're foreclosing an individual asset which is diminished because it's much more valuable when it's a part of the sum of the business as a whole, whereas this structure is really intended to try to keep the business as a whole together because the mutually assured dependencies that exist.
Yeah, imagine you really break the risk reward ratio there a little bit because you've got a lot more risk mitigation than you typically would have. You probably get better yield than something that's more vanilla. And despite all of that, it's a really cooperative kind of structure where everybody's incentivized to make it work. So in terms
that's a great point too, Dylan, because I never, typically in a negotiation, people can approach negotiations as zero sum and it's all about winning points and whatnot. This is really about building a mousetrap that works, and I take that approach whether I'm on the on the borrower or issuer side or whether I'm on the lender side. Everyone has a commercial outcome that they're trying to achieve, and everyone wants the structure to hold up. Sometimes you'll have to make accommodations because of tax planning. Obviously, you don't want to solve one problem and create another by creating a huge tax liability. Or it may be that you don't necessarily want to get consent of a third party to transfer certain contracts which are inextricably tied to the intangibles, and so you'll create workarounds to address that. And so it really is all about the art of the possible. But then you tailor it to meet that commercial objective.
Interesting. So you said there's almost no limit to which intangibles go into this. So I would imagine some are much easier than others. So something like a patent that's registered with the USPTO can be assigned, with relative ease, versus some are presumably more difficult to perfect. So is there a bit of a continuum there? How does that work?
Yeah, no, the regime for perfection in the US is actually, it's pretty clear. Typically, we have the UCC, which is the vehicle to protect most forms of intellectual property. The one exception typically is exclusive copyrights or copyrights that are registered. And that's both registered copyrights which are owned or exclusively licensed. And that's because an exclusive license constitutes a transfer under the Copyright Act, and they need to be also recorded with the office. And a transfer includes a hypothecation. And so the way you perfect for registered copyrights is with the Copyright Office. Obviously, under the USPTO regime, you can record your security interest, and it's best practice to do that. But the way you actually perfect, at least based on the current law, is through the filing of a UCC. And yeah.
So it's something like customer loyalty programs, which is not a traditional registered IP, that would be achieved simply through contracting with a well-drafted contract to say that, you know,
and the filing of a UCC. That's right.
UCC. Okay, cool. Yeah, so you wrote that it's important that the asset is very foundational or mission critical. Could you expand just a little bit, you know, why that would be such an advantage?
Yeah. So, like, for instance, in the airline context, again, I'm sorry that I go back to the old chestnut, but it's the one that's easiest for folks to understand. So, a loyalty program without an airline is really of diminished utility, given how inextricably tied it is to the carrier. But an airline without a loyalty program also is a diminished competitive force, given that consumers and travelers really expect to have their loyalty rewarded through miles. And so because of that, you have then two pieces which are completely dependent on one another and really need one another in order to succeed. Now, technically, you could stand up a loyalty program and take those loyalty customers and migrate them to another airline if another airline wanted to honor their miles and their loyalty and expand their traveler base. And so there is some independent value, but the real value is in keeping the two parts together. And so that creates the mutually assured destruction paradigm. And so you have a foundational piece, and obviously a going concern, which is critical to the loyalty program. And so, in the event of an insolvency event involving the airline, all of the incentives are to stand up that loyalty program, because the way the drop down is structured, it will not be able to set up a rival program, because there's a non-compete, there's liquidated damages if there are certain breaches of those conditions, and again, all of the incentives are to keep the structure in place. And so that's in the loyalty context. In the technology context, it can be a foundational piece of software which is at the back end and processes all of the bookings that happen in the case of Sabre, which has a global distribution system. And so that is the foundational piece. It could be a brand. It could be a combination of all of those things. And ultimately, what you're trying to do in all of these structures is to have a criticality of intellectual property, but also intellectual property that can be valued, so that you can create the loan to value and a plausible story there to sell to either an investor or a lender.
So the more foundational it is, the more incentivized everybody is to keep everything working nicely. And that's you write about it being extremely important that the business can have use of the asset as if nothing changed, and that's because it's so foundational. You would actually interrupt the business if that wasn't the case.
Yeah, and that's if I can sort of elaborate on that too, Dylan, because it's so the license back to the airline ensures freedom to operate. That license can be terminated in the event there's a breach, and so if the airline, if the borrower ceases to pay royalties or tries to infringe the exclusivity or violate the exclusivity. Now, in the US, we have an automatic stay, and typically termination in the event of bankruptcy is ipso facto, which means that essentially your a right to terminate could be frustrated in a bankruptcy scenario as the licensor. The way we try to create a workaround in our structure is we interpose an entity between the borrower or the issuer and the ultimate licensor. So essentially what they're getting is a sub-license. And what we do is we terminate the intermediate license, which is not in bankruptcy, and we make it clear that the sublicense automatically terminates upon the termination of the license that's granted to the intermediate entity. And so in that case, it's not ipso facto, and it is subject to, it's a way to work around the automatic stay. And I talk a little bit about that in the article as well. But it's a very novel piece of deal technology, because the automatic stay is one of the impediments under the bankruptcy code that you have to respect. And that's why I said at the outset, you really need to understand how every domino falls, and it does require not just an understanding of intellectual property and technology, but also how the intangibles interact with their treatment under the bankruptcy code.
Yeah, got it. And valuations, part of the process is what? To set effectively the amount of capital that might be financed against it, and then an LTV, for credit rating agencies and so on to feel that it's reasonable.
Exactly. And listen, valuation of intangibles is an imperfect science. Yeah. There are different accepted methodologies. There's a cost approach, which some valuations are based on where you look at the replacement cost. There's a market approach, where you'll look at what similar assets have sold for. But that's really something that consultants weigh in on. It's not really a legal analysis, but it is a fundamental part of the process.
And do the two parties, argue about those, or is it just outsourced to consultants, and as long as it feels reasonable, it's used, or is there a bit of a trading about that?
Yeah, in my experience, at least, I think, I think people know who the reputable players are. They look at the methodology, and especially the investment firms, they're very sophisticated in understanding financial models. The other approach, which I omitted, was the income approach, where you look at what income is being generated through the intangibles, and then you net present value them. So there has to be some meeting of the minds, but in my experience, that is there is certainly some negotiation around it, because obviously the incentives are for the borrower or the issuer to create as much value as possible, and for investors and lenders to be more skeptical. But usually I think there is a sort of an accepted practice in that regard.
That's something that we're working on a lot at Intanify, is lifting the veil on those things a little bit, because as a former investment banker, it's really not that complicated, actually, and those methods you're talking about. And coming new to this industry, I was taught by many people it's the dark arts. It's all, but it's really not. And I think as long as it's transparent, different case for the types of transactions, $10 billion you're talking about, hedge fund on one side, somebody advised by Goldman on the other side, but for everyone, and there's $60 trillion of these assets, there isn't a good understanding of the valuation of those, and that shouldn't be the case, because it's not that complicated. Or at least everybody's going to be wrong, but at least everybody be wrong, more or less doing the same thing, and then it can be adjusted. Cool. All right. So there's a natural information asymmetry there, isn't there, but between the owner of the intangible, that if we think about it in terms of something like a technology, very complex piece of code, clearly the company has the best understanding of anybody of what their code's like. Financier, outside looking in, will do some DD during the process, but could never have any kind of similar understanding. How do you manage that? Because you act on both sides. So how do you treat the client?
It's really diligence. It's really it's a deep dive, and that's why it's never a one size fits all. I mean, there's diligence on the criticality of the IP, and understanding how easy it would to create a workaround. So if you're dealing with a software based, understanding how sophisticated the technology is and how complicated it would be to replace it. Then there's the tax planning, because that's usually a third rail. Companies are not going to want to upset their tax planning, and so usually the lender or the investor really has to respect that and get their arms around that and understand what's real and what's possible. And so you have to do that. Then you have to do the contractual diligence to see what can be assigned. So I think I may have mentioned this earlier, in some cases in the airline context, the actual credit card agreement can be assigned and is assigned to the SPV. And in other cases, the airline did not want to seek the consent, and so only the proceeds are being assigned. And that's fine, because it sort of achieves the same commercial outcome. But again, you can only get to that point if you sort of allow the counterparty to do the necessary diligence, get their arms around the terrain, understand what we're trying to solve for, understand what we're trying to drop down, and create the value.
Cool. Yeah, that brings us neatly on to where I wanted to focus the last bit is, obviously Davis Polk, one of the top law firms. What we're talking about here is extremely complicated. You mentioned deal technology a number of times as an interplay of 5 different departments, all with, I guess, some of the top boys on the street. The transaction I looked at that you did for the airlines was like $10 billion. What is the bottom end? What is the minimum that actually makes sense to get a firm like your firm, involved in one of these?
So I've done structures where the financing was $100 million and a couple of hundred, and then, as you say, in the airline context, it was many billion. There's a lot of it is a heavy lift, and so I think, but below that amount may be challenging when you take into account legal fees. Typically there'll be investment bankers involved in these structures, so you have those fees, and then you obviously have the cost of the facility itself. And so I think that's probably the range of what you're talking about in terms of deal size.
Yeah, so even 100 probably seems light. That must have been 5, 6, 7% of that is fees. But so, what do you think? In a world where 90% of assets are now these assets, and there's really not that much financing against them. This structure is highly novel and is probably ahead of what will come. But what do you think it takes for more cookie cutter, less bespoke types of structures to come about that could be used by many companies, smaller companies, a little bit more off the shelf? Probably not by your firm, but
no. And listen, the beauty of the exclusive license structure that I talked about earlier is it's a very nimble form of the deal technology, and that's why I do think it doesn't require setting up a separate special purpose vehicle. In the airlines, a lot of these special purpose vehicles were set up offshore, and so I do think for companies that do want to not necessarily drop things down into an SPV, but want to encumber the IP through the exclusive license structure, there may be a scope. But again, it's the reason why I don't think it can be commoditized typically is because of the complicated interaction of all those dominoes. You kind of do need a full service offering to make sure that everything works in lockstep and in the manner intended. But I do think there are ways to explore different structures which are more nimble and are less intricate.
Yeah, because I can't remember what the numbers are for the US, but I'm sure most of the companies are more like 10 or 15 or $20 million companies. So, and also 80, 90, 100% intangibles. So this financing that we talked about mostly today is not really available to them. But surely that needs to change in the future, because it can't always be the preserve of billion-dollar companies.
I think that's right.
Yeah. Cool. So yeah, I've understood from speaking to people who've been on IP for their whole careers, really, that IP financing has been talked about forever, really, and is it's not really happened at scale. And the theory for that was because most assets, are in paperwork or contracts or filings somewhere, and never really represented digitally. I'm wondering if that sounds like it makes sense to you, or whether you have any reflections as to why intangible financing has never really become more widespread yet.
Yeah, if I had to guess, I really do think it's because of what I said at the outset, that in some respects, intellectual property and its very bespoke treatment under the bankruptcy code and some of the bespoke rules of perfection, it sometimes falls between two stools where finance lawyers sort of see it the realm of intellectual property lawyers. Most intellectual property lawyers don't see it as their realm because they see it as a financing domain. And then you have bankers that potentially see it as potentially prohibitively complicated. But I don't think that is the case now. I think people are getting much more sophisticated, especially on the banking and on the company side. I think companies realize the tremendous value that they have in these intangibles. They recognize that, if they look at where the value of their businesses lie, if you look at the United States, what do we export? We export technology, we export content, and we export branded articles, and so those three things just really do lend themselves perfectly to these structures. And if you can leverage them and untap value that's currently being underutilized, it's tremendously transformative for a company. And especially companies at the moment, for instance, who may be having maturing credit facilities where things are going to reset at a much higher interest rate, and they'd like to pay those down and procure financing on more reasonable terms. This really can provide just a tremendous vehicle for them to do that.
Yeah, cool. All right, so final question, getting your crystal ball out a little bit. Where do you think the space goes in the next, say, 5 years?
So I think given where interest rates are, and given, I think, where we are potentially in the insolvency cycle, and I think given where we are on a macroeconomic level, where I think the economy may contract, we may go into a period of recession. Not that I'm a prognosticator by any stretch. Yeah. I think those conditions all are ripe for companies who will increasingly have much more pressing liquidity needs. And so if I look in the sort of near to intermediate term, I really do think that the impetus for these type of financings is just going to increase.
Mm-hmm. Cool. All right. Well, Frank, thank you so much. That was very, very kind of you to share your wisdom and your thoughts on this, and we'll look forward to continuing to watch the amazing things that your firm does, and hopefully ourselves helping to come up with something, for the smaller companies that not necessarily afford great firms like yourself.
No, it's been an absolute pleasure. Thank you so much for the opportunity, Dylan.
Cool. Thanks very much, Frank.